Friday, July 20. Let's see, dodging bullets. Fed met this week, could not have been more dovish. The market for long-term rates, aka the bond market, looks a little itchy about the potential for inflation. The CPI report this week was out of the box. We're going to get some more data next week, but rates have been so low for so long, and the marketplace around interest rates has been so artificial, trying to get us out of the Great Recession, that nobody but old people remembers how we used to watch markets and how we used to watch the market work with the Fed. Now, the Fed is saying that it's going to stay easy for a long time, but long-term investors may or may not be pleased with that idea. Now, one thought is that a 0% Fed means that it's easy to finance a bond portfolio and make good money on leverage, but bond market investors aren't completely suicidal. If the Fed stays at zero and inflation starts to build and the Fed decides that it wants to do all it can to help the economy and the labor market, and it's going to tolerate some more inflation, here's a visual. Up one side of the axis go interest rates. Down here goes time, which generates a curve of some kind. Fed's here at zero, at the apex. The Fed's money is time zero from one day to the next. Further out here you go, you get out 5, 6, 7 years, you're in mortgage land. These guys have a completely different agenda from the short end. And if the market begins to think that the Fed is too easy, too long-term rates will start to go up, even if the Fed maintains its anchor. You could get something also completely perverse. Let's suppose the Fed gets spooked by inflation, or politics, or whatever. It begins to ooch up over here. Comes off the 0 to a quarter band, it goes to 0.5% overnight cost of money. I've lived through many times when the bond market thinks, idiots, they're going to collapse the economy. Buy bonds. Not likely. What's in our future, next couple of years, Fed's going to start to push up and the whole yield curve is going to go up in one piece. The signal of the next recession is when it does this. The yield curve inverts. Near term, day in and day out, I'm watching the long end to see if it stays put. See if mortgages stay here at 4.5. Next inflation report is next week. Job report is delayed until almost the middle of July. But once this thing starts to move, and it has, cyclical forces will begin to come into play. Watch the long end. Thank you very much.